You're about to hear my conversation with Matt Moody, who leads the Ivy team. We talk all about how they select stocks, how he thinks about portfolio construction, and what investors can expect from Ivy. I hope you enjoy. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to The Invested, a podcast from Mackenzie Investments. My name is Matthew Schnurr. I'm delighted to have Matt Moody, who leads the Ivy franchise, on the podcast. Matt, welcome.
Great. It's great to be here.
Matt, I thought we get started with a bit of background on how you think about investing in stocks in general. I'd say that the Ivy brand is particularly well known for their focus on quality. Can you tell me how you define quality?
Sure. It's a good place to start because we have always defined ourselves as quality investors. And I think, if you stretch back many years, that used to be enough of a differentiator to kind of say that as your stated style. But there are sort of over the years, there have been a lot of other mandates sort of crop up that do take on that quality moniker. So it is important to kind of differentiate what we mean by quality at Ivy versus what others may interpret as quality. So as a starting point, it means for us what it means for other people, right? You're looking for companies with identifiable competitive advantages, good growth prospects, high returns on capital, all that kind of great stuff. And so that is quality for us as well. But on top of that, we do sort of emphasize a few extra elements. It's kind of our own little spin on the ball, if you will. And, first and foremost is corporate culture, which is really the personality of a company. And, people who have heard us talk in the past are probably tired of hearing us talk about this, but we do think it's one of the most underappreciated parts of a company's quality, because a culture is what can take a competitive advantage of a business and allow it to endure for many years, right? So that you're not just great this year and next year, but you're really great for many years into the future, which is what matters to us because we are looking for those kind of long-term investments in those companies whose greatness can endure. So that's corporate culture. It's a tricky one because you can't measure it. You can't even prove it exists. You can't put it in your spreadsheet and model it. But it does matter a lot. So it is sort of a big component of quality for us, and we do spend quite a bit of time thinking about it and trying to analyze it. The second aspect of culture that we kind of emphasize is economic resilience, right? We do have some investments in some more economically sensitive businesses, but by and large, we do prefer those ones that can kind of grow through thick and thin, where success is more in their own hands and it's less dependent on what's going on in the broader economy, because of course that's out of their hands. They can't control it. And from our perspective, we have a hard time predicting it. So we do have a built-in preference and bias towards those kind of economically resilient businesses. And the other thing I would kind of highlight as a third element that we put a lot of emphasis on is balance sheet strength, right? Like is the company really set up for tough times? And we do have a preference for companies that are conservatively financed as a general rule, so that when those tough times come, because they always do, these are the companies that can stay focused on running their business, right? Outcompeting their competitors, serving their customers, right. And they don't get sort of distracted. All the management attention is on, how are we going to roll over our debt, or how are we going to, refinance and all this kind of stuff. So that's why we like strong balance sheets. And frankly, it's also, we think, another one of these unimprovable beliefs that's tied into culture, is that how a company manages its balance sheet can also be a little bit of a window into how they run their business more broadly, right? So if they're being careful, especially in good times, if they're being careful with how they're financed, they're probably also being careful in many other aspects of their business that we don't have visibility on, right? And the opposite is also true, of course. Companies that are comfortable running very aggressive balance sheets, you know what? They're probably being kind of aggressive in some other areas that maybe you might not be seeing as well. So it ties back into culture, and it ties back into, for Ivy, our sort of style, really, our philosophy of being careful stewards of our unit holders' capital.
I'd love to double click actually on corporate culture. You referenced the balance sheet being an indication of the culture that resonates with me. I get you, the more conservative or the more careful, I should say, that you're running your balance sheet, perhaps that obtains to different areas of the business. Are there any other sort of notable things like balance sheet that you also look for, or is it more idiosyncratic company by company?
Well, it is sort of company by company, but really what we're looking for is a couple common threads. One is you want to see signs that the management team is truly thinking about the long-term growth and building of the business and less concerned about how their business is doing on a quarterly basis versus Wall Street expectations, right? And you can see it in a variety of different ways. It could be how they talk about it in the annual report. It could be how former employees talk about the company that they were part of. It could be just from reading their earnings call. You have companies that you look at their earnings transcript at the recent quarter, and right off the bat, they started off with, "We beat consensus estimates for this quarter, hooray."
Right.
And it's like, okay, well, that's great. But we're more interested in are you thinking about how you widen your economic moat and how you set the business up for success for a long period of time? And maybe that necessitates, not doing so great in the short term or taking some steps that are, a cost for the business in the near term that can lead to success down the road. And, very brief example, it's a very basic one, but I think it is telling. You have an example like Colgate. It's one of our bigger holdings currently. And their current management team is quite dedicated to reinvesting in the brands at a very high level. So if you look at 2023, they had a pretty big step up, both in absolute terms and as a percentage of revenue in their brand support, which is essentially ad dollars. And if you think about it at a very basic level, they could have reported better profits last year if they wanted to, right? But instead, they chose to take some of those profits, reinvest in the brand so that they can ensure the duration of their success for many years ahead. And that's kind of what we're looking for. So it's that long-term focus. The other thing that is a little bit more nuanced and that is a little bit maybe idiosyncratic is they have a clear idea of what makes their business successful and that is what they invest in and dedicate themselves to day in and day out. And that can take a whole bunch of different forms. And if you take, for example, Stryker, medical technology company in the US that does implants like hips and knees, assorted other products that are sold into hospitals, cameras, all the way up to hospital beds, you name it. And, they outsell their competitors year after year. And their CEO, if you were to ask him about the business, it's very succinct and very clear. He's like, look, our superpower as a company is our commercial offense, right? And he boiled it down to that one idea. They have a phenomenally effective sales force. They invest heavily in it in terms of money, but also in terms of time, right? They know that is what sustains the success of their business. And they just wake up every day knowing that they have to reinvest in that in order to maintain that success over time. So it is, again, you can't prove it. And it is nuanced. It depends from company to company. But those are the types of things we look for, that long-term focus and that clarity about what it is that makes that business great.
Great. Love the examples, Matt, in that case. I think really illustrative. I'm curious on your portfolio construction. You're also well known to have a quite highly convicted portfolio, fairly concentrated. Tell me about what you think about when you're putting together the portfolio and how you get this collection of companies.
Yeah, and it is a bottom-up built portfolio. So we are looking for those great businesses that fit the Ivy definition of quality. And importantly, we're trying not to overpay. It's not quality at any price. We do have a pretty rigorous valuation discipline. And it isn't so much important to us what it is the business happens to do or where their headquarters is located. So we do tend to look pretty different from the benchmark, whether it's from a geographic perspective or from a sector perspective. And that's fine because there are types of businesses where, that just frankly don't fit as much the Ivy model. And so you will see hefty weight in financials in general. There are no banks in the fund, and there haven't been. We had one a couple of years ago, but over long stretches of time, there have been no banks in the portfolio. We don't have any utilities. We don't have any telecom companies. We don't have any oil and gas companies. And there's no rule against it. We have in the past, and we may again in future. but those are just areas where those elements of quality that we really look for are hard to find. And so, we don't mind being different from the benchmark, and we don't try to construct the portfolio to be kind of like benchmark plus or minus, right? We're okay being different. And so that does show up in a pretty different looking portfolio at times. As you said, it's relatively concentrated as well. So we just try to diversify it by the type of exposure that we have, right? When we assemble from the bottom up this portfolio of great businesses, we take a look and say, okay, are there overlaps in terms of either the end customer or the economic underpinnings of these businesses? Are we overexposed in some areas? And also, are there blind spots, where we are underexposed to areas where we might want to shine a light and take a look? So it is very much a bottom-up assembled portfolio, but there are obviously top-down considerations as well.
And just maybe on the top-down considerations, so bottom-up makes a lot of sense, looking for these highly convicted businesses. You talk about diversity sort of end customers. Maybe expand on that a little bit more. How does that translate to sectors or countries, or does it not? And what sort of elements you reference a little bit of top-down? What sort of top-down elements are you looking at?
So if you look geographically, what matters to us is not where a business is listed, right?
Sure.
If it's US listed, it shows up as US. If it's UK listed, it shows up as UK. But really, that may not tell you about the economic exposure of the business in question, right? If you look at something like McDonald's, which is one of our holdings, it's a US company, but most of their money is earned outside of the US, right? Same thing with Colgate, which we already talked about. And conversely, there are companies that are listed in Europe, where most of their business comes from North America. So looking at a company's sort of ticker and where that's listed may not tell you about where the economic exposures of those businesses are. And for us, that's what matters. I should emphasize, we do favor those kind of global champions, right? Where their success is not solely reliant on one particular economy, especially if those economies are relatively small, right?
Sure.
We wouldn't want a business that's a great business, but is solely dependent on the ins and outs of what happens in France or South Korea. We could have holdings like that, but we take into account that they are highly reliant on an individual economy. And we're not economists, and we don't try to predict what economies are going to do well and which ones aren't in the years ahead. So we like to have that spread of exposure geographically to our businesses. And then you can look at sort of end customer overlap. We have a lot of exposure in healthcare and consumer staples, two kind of good economically resilient areas that tend to be good hunting grounds for us. But we want to be careful that we don't put too many eggs in one basket and have 5 or 6 or 7 really great companies that are high quality on their own, but are highly dependent on the exact same trends and the exact same customers, where we might find that we have some correlated risks that we don't particularly want. So one of the benefits of having a relatively concentrated portfolio is you kind of know what you own, right?
Sure.
And we can go through business by business and say, okay, are we sort of over-indexed on something that might cause us trouble down the road? And the same would be true for areas where we don't have as much exposure, and we can ask the question of, should we? And are there high quality businesses that are exposed to areas that we don't have much exposure to that we should maybe think about?
Why don't you take us through 2024? We were recording this on May 21st. How has it been going, and what have you seen sort of within your portfolio, and compare that to sort of the overall market?
So 2024 has been kind of an extension of 2023 in that you have a market that's pretty strong overall, and it is being driven more or less by one theme, which is AI and all the excitement around it, and NVIDIA and all the sort of related companies. And that's an area that we don't have sort of full exposure to, if you want to put it that way. As a sort of general statement, the Ivy funds don't tend to keep pace in markets that are really hot, and particularly markets that are really hot that are driven very narrowly, as the past sort of year and change has been. So if you look at Ivy Foreign Equity, the returns have been lagging the index year to date, as well as last year. It's really a continuation of last year, while being pretty good in absolute terms and getting our clients closer to achieving their long-term financial goals. We are behind the index. And, that's something that obviously we don't like, but it is how we explain our way of investing to clients. This is the typical performance pattern for Ivy, where, you will have these periods where the market is running hot. There's more greed than fear, and maybe a little bit too much excitement. Those are the types of environments where we will probably not keep pace, and we should not be expected to keep pace. The converse of that is that when volatility emerges and when there are concerns about economic downturns or financial distress, that's where the funds tend to hold in relatively well. And so we're really looking through cycle to provide, good long-term risk-adjusted returns for our clients, recognizing that there are periods of time in every cycle where we're not going to be keeping up with the benchmark. And currently that is the case. If we look at our fund sort of year to date, and even last year, broadly, we're happy with how things are going from a fundamental perspective. The businesses are performing more or less how we would expect them to perform. We're finding some opportunities out there in areas that are being a little bit overlooked right now. Almost by definition, when everybody's excited about a couple things, there are large pockets of things which may be a bit less in focus for other investors, and that's where we can go hunting. So we're happy with how the portfolio is positioned. We're happy with what we own. We're mostly happy with the prices that we're being asked to pay for the things that we own. And so we think from a long-term perspective, we're set up pretty well. But as long as the environment continues where it's being, driven by excitement around a single theme, where it's not really in our wheelhouse, then that is probably an environment where we're not going to be fully keeping up. I should say we're not totally absent what's going on. We do have exposure via holdings like Alphabet and Microsoft and Oracle, even tangentially things like Amphenol, which supply some of the interconnects and sensors that go into data centers and things like that.
Right.
So it's not that we're totally absent the AI theme, if you will, but it's fair to say that we're underexposed.
Tough to overweight that segment, especially as it continues to grow substantially and quickly. Curious on your reference for the long-term mindset. Talk to me a little bit about the view in your longer-term sort of 10-year time set. How did you come up with how you're looking at the companies, and what implications does that have when you're selecting the companies?
So when we're analyzing businesses, we do take, as you mentioned, a 10-year view. That's what we form our analysis on, and that's how we build our assumptions. And there's nothing magical about 10 years. Like, it could be 8 years, it could be 12. Like, we're really substituting, a full economic cycle, right?
Right.
And so we've chosen 10. It's a nice round number. It works well. And what that allows us to do, well, two things really. The first is that it focuses the analysis on what matters for the long term, right? When we're analyzing a business, we get out of the game of trying to predict if a company's going to beat their 2024 estimates,
right?
Or, if this new product that they're coming out with, is it going to succeed or not? Really over a stretch of 10 years, that may not matter, right? So really getting at what is it about this company that will make it endure and survive and thrive over many years is what we should be dedicating our time and effort to figuring out. So that 10-year view really feeds into that. But sort of importantly also, it forces us to incorporate the impact of a recession on the business in question without having to predict when those recessions are going to happen, right? We're not economists, as I mentioned, and we're not in the game of trying to predict, what our rate's going to do this year, what's inflation going to do, is it going to soft landing, no landing, hard landing? That's not really our forte. We just assume, look, over the course of 10 years, a recession is going to happen, very likely. Could be year 2, could be year 4, year 5. It doesn't really matter. But having the mindset that when we look at a business and when we value it and build our assumptions, we have to assume that there will be a recession, right? We can't just assume everything is up and to the right and roses and unicorns for forever and ever. So what that does is that it does lead us to question the durability and sustainability of growth for more cyclical businesses, and to incorporate the inevitable downturn on these cyclical businesses into the price that we're willing to pay. And that can lead us into, as it is currently, a portfolio that is a little bit more defensively positioned, right? Because we're trying to incorporate the impact of a recession on all the businesses that we look at. Now, it could be, you could get in environments, especially in deep downturns, where, we might be going the other way and we might be finding more opportunities in more economically sensitive businesses.
Right.
Because just like in good times, we assume recessions are going to happen. In bad times when everything's dire, we just assume things are going to get better, right? And so that can provide opportunities from a bottom-up perspective to buy into companies that are really suffering or stock prices that are really depressed because of near-term concerns when we have fewer concerns on a long-term basis. Maybe just to bring this to light a little bit, last year, one of the pockets of the market that was a little bit volatile and a little bit weak was anything to do with bioprocessing, which is basically drug production for biological drugs, right? So anyone who sells tools or consumables into this environment was having a really tough time, because what happened was during COVID, there was huge demand, not just for vaccines, but you also had with, interest rates on the floor and a lot of venture capital money going into the space. Everybody was researching and developing all kinds of drugs, and they wanted to get their hands on as much of this stuff as they could. So there was a real boom time for companies that supplied these things. And there was also a lot of inventory build at their customers. And then what happened was sort of the rug got pulled out a little bit, where the venture capital money dried up, the demand for vaccines dried up a lot. A lot of the COVID-related stuff dried up, and companies still had a lot of inventories to work down. So the suppliers into this market, companies like Danaher, which we own, and Merck, the German Merck, not the U.S. Merck, they also supply into this market. Their share prices kind of were suffering, because if you are in the business of trying to figure out the near term, like, are they going to meet their guidance this year? That's really tough to figure out. We couldn't figure it out. But for us, it didn't really matter, because the long-term structural underpinnings of their growth we felt were intact, right? So we were not as concerned, and we increased our position in Danaher. We initiated a position in Merck, knowing that, look, we might get the near-term timing wrong, but that's fine, because we think that the price we're being asked to pay for that 10-year view is really quite attractive. So I think that's an example of how having that different time horizon can lead to some opportunities, pricing opportunities, where others just don't want to assume the near-term risk of getting it wrong.
Very interesting, man. Curious on the approach to ESG within your portfolio as well. I would assume that in some cases that long-term view means that ESG is a factor that's going to be important to you, but maybe elaborate on what you do within that space.
Yeah, it was interesting when ESG became a lot more prominent in the investing world, and we never certainly called it ESG, but to your point, we always did have this mindset of long-term sustainability, right? It's baked into the DNA of Ivy, right? And companies that are focused back to this idea of long-term growth of their business, building something that's going to last, they're mindful of risks that are sort of 5-10 years in the future, and they're already investing behind making sure that they can adequately address them. These are the companies that end up looking good from an ESG perspective, right? So when our portfolios were sort of put through various quantitative screens and evaluations, we ended up looking pretty good from an ESG perspective, without even, frankly, trying. And so ESG has always been a factor of our analysis, and since has become more formalized in that we do sort of specifically lay out, okay, what are the ESG risks facing this company, and how material are they, and how are they being managed? And it's not a checklist, and we certainly don't outsource this to, how does company X look, sort of how is it scored by an external supplier,
right?
Because they're interested in different things than we are. We're really interested in the one or two things from an ESG perspective that really are impactful for the company in question. And just to give an example, so one long-standing holding, I think we've owned it for, I'm going to say 16 years plus. So Admiral Group, a car insurance company. And, from an ESG perspective, there is a solid ESG underpinning to this company, but it has nothing to do with the E, right? Of course, they have to have their disclosures about what their environmental footprint is and so on. But, frankly, it's not as impactful for them because they write car insurance. It's a couple people in an office, there are no factories.
Sure.
So it's not something that really occupies our mind for the long-term sustainability of this business. But the S part is crucial, because back to this point of culture, that is what makes this company great. And frankly, without it, they would be mediocre because they are in a highly competitive and frankly commoditized industry, especially in their core market of the UK. Car insurance is highly price competitive and commoditized, yet they've succeeded over decades. The only reason they're able to do that is because of the culture that they have built and carefully nurtured at the company that attracts people to the company, it keeps people at the company, and it helps them behave in a different way than their competitors do. And that's really, really hard for others to copy. And it's why we love the company. So that very much for us is an ESG risk, right? Can they keep on the governance side, but also the social side, their corporate culture, can they keep that intact? And are they adequately investing in it? Are there risks to it from, work from home, right? If they're not in the office, are they able to still have that same culture that they had prior? So it becomes very much an ESG focused analysis, but it's really the only part of ESG for Admiral that we pay a whole lot of attention to. So the way that we would score, if you will, or rate a company's ESG might differ dramatically from what you'll see from other, ESG rating houses or whatever you want to call them, because we're just focused on different things. And it really is those one or two impactful material things per company that are going to allow them to thrive for 10 years or not.
Makes a lot of sense, Matt. Just as we conclude, one thing that Ivy as a team has always done very well over the years is client expectations and making sure that clients are able to understand what the intended result is from holding your mandates. You currently have two of your more flagship global products. One is the Pure Equity Solution in Ivy Foreign, and then we also have the Ivy Global Balanced. Maybe talk a little bit about setting client expectations, reiterating what clients are expecting, and then also that bifurcation between balanced and the full version.
Client expectations are crucial, obviously for any fund, but for ours in particular, because it is a little bit of a distinctive style that has tended to result in a pretty distinctive performance profile. And it is important that people understand what that is. And so for clients, the first thing that they should expect is that, Ivy, it's been around since 1992. It was always centered around a very specific way, a particular way of investing. It's the same today as it was in the past. Like, we're staying true to what made Ivy Ivy. So they should expect that what we're doing today is similar to what was done a decade ago, 20 years ago. Like, the consistency in approach and dedication at Ivy, the patience and the discipline, the focus on quality, that is very much intact. And so clients should expect us to behave in future as we have in the past. Now, that in the past has led to pretty particular performance profile. And, put very simply, we've touched on it already, when markets are hot and when there's more greed out there than fear, odds are that we're not going to be keeping pace. And, that was true in the past year. It's been true in most hot bull markets in the past. And conversely, when times are tough, a bit rocky, maybe markets are suffering, and there's more fear than greed, that's when you should expect the Ivy portfolios to be doing better than most. And again, that has been seen consistently in market drawdowns in the past. And I'm talking about significant drawdowns, right? Like not 2, 3, 4%.
Sure.
And so that over time has resulted in a performance profile that has been, well, frankly, a smoother experience for clients, right? Less peaks and valleys on the mountain chart. More likely, we think, that clients can stay the course and remain invested and not, panicking at the wrong time and asking their advisor to sell. So we think it can lead to very solid client outcomes, keeping them invested with a sort of good risk-adjusted returns over full market cycles. But it's important that people understand that that's what they should expect. We're not out there to outperform every single year. We're certainly not out there to outperform when the market is super hot, and that's not what we should be expected to provide. And so it's a type of investing style that requires patience and discipline on the part of all parties, right? On the part of advisors and on the part of the people at Ivy and Mackenzie who are investing in this fashion to stay true to the style and to keep that long-term view and to deliver that sort of good long-term performance that clients are looking for. So that's the performance profile of Ivy. You did highlight the global balanced versus IV foreign equity. And put very simply, global balanced should provide the same performance profile as IV foreign in the context of its category, of course, being a balanced fund. The equity portion of IV global balanced is basically identical to IV foreign equity. The main difference that is kind of important to point out is that IV global balanced is and will always be fully invested, right? It's got the equity component that's more or less 75%, give or take a couple percent. And then the fixed income portion with very little cash. IV foreign equity can and does have a bit of cash. We currently have 8 or 9%. That will range between 0% and 15%, depending on where we see opportunities to invest, consistent with our quality criteria and our valuation discipline. So there is currently a little bit of cash in IV foreign equity. So that is the most material difference between the two portfolios. But by and large, they should perform kind of with the same performance profile.
Well, Matt, thank you for spending so much time with me, walking through how you approach markets, what people should expect to at Ivy. Really appreciate your time.
Hey, great to talk to you, Matthew.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may be associated with mutual fund investments. Please read the fund facts and prospectus before investing. The indicated rates of returns are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.